S&P 500 futures are tickling up 0.23% in the overnight session. Nasdaq futures are leading the bid, up 0.51%, and the 10-year Treasury yield is holding firm right at 4.60%. It is Wednesday, July 15th, 2026. The bell hasn't rung yet, and, well, consider this your ultimate prep sheet for the implied open.
Right, because if you're actively trading today, or even just trying to understand where global capital is flowing, you need the actual data, not the noise.
Exactly. We are unpacking an institutional-grade market strategy briefing today to decode this intense tug-of-war happening on Wall Street right this second. The best way to visualize the tape right now is think of it like a tightly coiled spring. It is being pulled violently into completely opposite directions. You have cooler inflation data pulling one way and escalating geopolitical military risks just, aggressively yanking the other.
Yeah, that coiled spring visual is exactly what the pre-market volume looks like. We are looking at a market frozen in a neutral stance, just vibrating with potential energy. When you have futures compressed in these tight structural channels overnight, it tells you that institutional algorithms are waiting. They are waiting for a definitive signal to release that energy.
Right, they're trying to price in two conflicting macro forces simultaneously.
Without getting caught off sides before the opening bell, exactly.
So let's start with the bullish side of this equation, the data that's actually pulling futures higher. Yesterday's consumer price index, the CPI print, it completely reset expectations. Consumer prices actually dropped 0.4% monthly. Headline inflation cooled to 3.5% year over year, which beat the 3.8% consensus.
That was massive.
Yeah, and core CPI, stripping out food and energy, eased down to 2.6%. That essentially evaporated the immediate rate hike anxieties.
Yeah.
We saw yields on the 10-year Treasury drop right into that 4.59% to 4.60% pocket, and the U.S. dollar index, the DXY, slipped below that critical 101 level down to 100.80.
And you have to understand the mechanics of why that drop matters. It acts as a pressure release valve for equities, specifically because of the discount rate. Look, tech companies are generally valued on the profits they are projected to make, 5 or 10 years from now.
Right, future cash flows.
Exactly. When interest rates are high, the math dictates that those future dollars are worth less today. That's the discount rate penalty. So when you see the 10-year yield and the dollar compressing at the same time after a cool CPI print, that penalty shrinks. Future earnings suddenly look cheaper to buy today.
So tech stocks get this tactical tailwind.
Right. A green light window opens up because the cost of capital isn't choking their valuations quite as tightly.
Okay, that makes perfect sense for the tech sector, but we have to address the other side of that coiled spring. Inflation is down, which is great, but geopolitics are aggressively capping any real pre-market celebration. I mean, we've got U.S. airstrikes in Iran and a reinstated naval blockade in the Strait of Hormuz. That supply chain chokehold pushed WTI crude near $80 a barrel, and Brent crude is up to $85.
It's a massive physical constraint.
Right. So with oil spiking because of a military blockade at literally one of the world's most critical energy transit points, aren't we risking an energy shock that brings inflation right back? Why isn't Wall Street hitting the panic button over stagflation today?
Well, the threat of an energy-driven stagflation shock is the exact reason why that coiled spring hasn't just, snapped upward into a runaway rally. The market isn't ignoring the geopolitics. It is compartmentalizing them against the immediate data.
Compartmentalizing.
Yeah, for the moment, the relief from that soft CPI print provides a temporary buffer. But the institutional desks aren't blindly charging ahead into the implied open. They are holding their breath for the 8:30 a.m. Producer Price Index, the PPI print.
The wholesale numbers.
Exactly. That wholesale inflation data acts as the final tiebreaker this morning. If PPI comes in hot, reflecting those rising energy costs from the blockade, that stagflation panic could materialize on the tape very quickly.
So the macro environment has basically given equities a conditional green light, strictly pending that 8:30 a.m. data. But looking at the pre-market gappers in the research, the money isn't just flowing evenly into the tech sector, it's aggressively rotating within tech. We are seeing a massive structural shift playing out in real time. It's hardware versus software.
It is a brutal zero-sum rotation, and the divergence in the overnight session is honestly historic. Institutional investors are actively liquidating legacy software portfolios and recycling that liquidity directly into hard AI infrastructure.
The contrast between the top pre-market movers today is staggering. I mean, on the hardware side, you have ASML. They just validated the entire AI hardware super cycle. They smashed their Q2 earnings with 9.33 billion in sales. And critically, they raised their 2026 guidance to an astonishing 43 billion to 45 billion range.
Which is just a colossal upward revision.
It's insane. Pre-market, the stock is jumping over 5%, trading around $1,838. But then you look at the software side, IBM just suffered a historic wipeout. We are talking about a 58-year worst single-day drop, crashing 25.2% down to $217 after missing revenue at $17.2 billion.
And you really need to look at why that happened. The IBM drop isn't just a standard earnings miss, it is a structural traffic jam. Money is physically trapped waiting in line for ASML's technology, leaving the software lane completely empty.
Right.
IBM CEO explicitly admitted on their call that enterprise clients are actively diverting their cash away from software and consulting. They're doing this specifically to secure supply-constrained AI servers and memory chips. I mean, ASML makes the extreme ultraviolet lithography machines that print those advanced chips. They are the ultimate bottleneck supplier.
It's like a business deciding to completely skip buying the standard software updates for all their employee laptops because they're taking every single dollar of that IT budget to buy a literal supercomputer instead. The corporate budgets aren't expanding. There's zero sum. You either buy the software or you buy the hardware. And right now, every major corporation is choosing the hardware.
Corporate IT budgets are prioritizing hardware capacity over absolutely everything else. If an institutional portfolio isn't exposed to the hardware stack right now, specifically semiconductors and chip manufacturing equipment, it is entirely missing the primary capital flow. The panic we saw in semiconductors earlier in the week, it's been thoroughly bought up by institutions realizing this exact reality.
The liquidity just rotates.
Right. Capital flow is entirely unsentimental. It is abandoning legacy software systems and aggressively hunting for infrastructure capacity.
Tech cannibalizing itself from software to hardware is fascinating, but, there is another entirely different playbook running concurrently. The old economy is quietly thriving on the exact macroeconomic condition that everyone assumed would break the system: high interest rates.
Yeah, while retail attention is hyper-focused on AI hardware, the financial sector is quietly printing cash.
Look at these numbers from the overnight catalyst. Goldman Sachs just completely rewrote the models. They posted a Q2 earnings per share of $20.98. Wall Street consensus was only $14.50. The stock is up 9% to around $11,140.
A massive beat.
Huge. And it's not just the investment banking giants. The regional banks are fighting back with serious force. M&T Bank posted a significant beat with $5.35 EPS and a 3.7% net interest margin. They hit a new 52-week high of $248 in extended trading. High rates are clearly highly profitable for them.
The resilience of that net interest margin, the NI, is the key takeaway here. A 3.7% IM for M&T Bank proves that the core mechanics of traditional banking are working flawlessly in a higher-for-longer environment.
Because they capture the spread.
Exactly. To put it simply, they are charging significantly more interest on the loans they issue than they are paying out in yield to their depositors. They just pocket that 3.7% difference. As long as rates stay elevated without triggering a wave of loan defaults, these banks act like cash flow machines.
But, and this is a critical but for anyone listening and actively trading the tape today, this earnings success in financials is actually masking a really dangerous technical trap on the indices. Despite these standout beats from Goldman and M&T Bank and ASML's blowout, index futures are highly compressed. We mentioned earlier that S&P 500 futures are only tickling up 0.23%. The institutional briefing sets the line in the sand support and resistance pivot today at exactly 7,600. Nasdaq futures are up 0.51% with a critical pivot at 29,989.9.
And those pivot levels are the volume-weighted average price zones, the VWAPs. They dictate institutional control.
Walk us through that.
Think of VWAP as the true average price a stock traded at throughout the day, based on both price and volume. Institutions use these specific levels, 7,600 on the S&P, 29,989 on the Nasdaq, as algorithmic tripwires. The danger here is the broader context. We have low summer trading volume, a high-yielding 10-year Treasury at 4.60%, and escalating Middle East tensions keeping the market on edge.
So if the banks are crushing it and ASML is booming, why are the technicals flashing a bull trap warning for the broader indices? How does a liquidity trap actually function at the open today?
A liquidity trap at the open occurs when market makers and algorithms use the early morning enthusiasm driven by those flashy earnings beats to manufacture a fake breakout. They know retail traders will see Goldman and ASML up big and want to buy the moment the bell rings.
The classic gap and go.
Exactly. The institutions will happily sell their shares to those eager retail buyers, pushing the price slightly above that 7,700 level on the S&P. But because summer volume is low, there aren't enough institutional buyers stepping in to sustain the momentum. The breakout stalls.
So they use the good news to draw you in and then pull the rug if the volume isn't there to sustain the pivot. If you are watching the tape this morning, the instinct is to chase that early momentum. What is the actual strategic execution to avoid getting chopped up?
The strategic execution is patience. You wait for the market to cleanly clear those pivots. 7,600 on the S&P, 29,989 on the Nasdaq, and then you wait for the retest.
You have to see it hold.
Right, the market has to prove it can hold those levels of support. If it spikes above them and immediately fails, algorithmic sell programs will trigger. They will initiate a sharp, aggressive flush down, designed specifically to trap the late-joining retail bulls who bought the top of that morning spike.
Wait, if algorithms are waiting to trap retail traders on these pivots, what are they actually looking for? What is the trigger that makes retail so predictable in these high-rate environments?
It comes down to what institutional desks call the pain trade.
The pain trade.
Yeah, it's the market move mathematically designed to inflict maximum pain on the consensus crowd. And right now, the consensus textbook playbook for handling interest rates is completely broken, and smart money is exploiting it.
Let's lay out the consensus first because, I remember my day one finance class. The rule is that high interest rates crush tech stocks. High rates mean future earnings are worth less today, so you sell growth stocks and hide in cash or bonds. So when the 10-year yield spikes, retail goes into panic sell mode. But this briefing highlights three structural realities that retail completely misses, starting with something called reverse duration.
Reverse duration flips the traditional textbook completely upside down. Retail investors forget that mega-cap tech giants, companies like Apple, Microsoft, Alphabet, aren't borrowing money to survive. They're sitting on absolute mountains of cash.
Wait, hold on. Let me make sure I'm following the math on this. Are you saying these tech giants actually make money when rates go up because of their cash piles?
That is exactly the mechanism. Let's say a mega-cap has $100 billion in cash reserves. When the 10-year Treasury yield spikes from, say, 2% to 5%, the interest income they earned on that cash sitting in the bank dramatically increases. They just made an extra $3 billion in pure profit without selling a single product or service.
Wow.
It acts as a synthetic earnings hedge. The extra billions they make in interest income offsets the valuation penalty of higher rates we talked about earlier. They are essentially functioning like their own central banks, weaponizing the high rates to their advantage.
They are their own central banks. That is wild. I mean, my day one finance professor owes me an apology. Okay, what about the spending side? You mentioned earlier that AI infrastructure is a zero-sum game. How does that factor into the second reality, secular AI capex?
This is the second major blind spot for the consensus crowd.
Hmm.
This massive capital expenditure, this capex into AI hardware, is rate insensitive. A major enterprise is not going to pause a multi-billion-dollar data center build just because the 10-year yield moved up 20 basis points overnight.
Right, the stakes are too high.
The spending is secular. It's a long-term structural shift, not a cyclical one that ebbs and flows with the Fed. Secular earnings growth, like ASML's $43 billion guidance, will overpower macroeconomic rate moves every single time.
So I see how reverse duration protects their balance sheets, and secular capex basically guarantees their revenue regardless of the macro environment. But how does this actually become a trap for the average trader? How does this lead to the third reality, the short squeeze trap?
The trap snaps shut when retail investors and underhedged institutional bears follow that old textbook we talked about. Retail sells their high-quality growth stocks at the local bottom simply because yields ticked up. They hide in cash. Meanwhile, the bears are shorting the market, betting on a tech collapse due to high rates.
Because they're playing the old rules.
Exactly. But then, the mega caps post blowout earnings anyway, entirely shielded by reverse duration and that rate-insensitive AI spending. The stocks rip higher.
And because those bears sold shares they didn't own, they are suddenly trapped in a losing position as the price climbs.
Correct. They're forced to buy the stock back at a higher price to cover their shorts and stop their bleeding. That forced, panicked buying creates a massive short covering squeeze, sending prices rocketing even higher. Retail is left watching from the sidelines, having sold at the bottom, and eventually they are forced to chase the rally at significantly higher prices.
So the primary strategic lesson here is to, stop playing the retail panic. Treat yield spikes as accumulation windows. When the crowd dumps high-quality, cash-rich secular leaders because the 10-year yield moved, view that as an opportunity to accumulate, not a reason to run for the hills.
Trading in this environment is about understanding the mechanics beneath the headlines. It's about recognizing that a yield spike isn't just a threat. It's a mechanism that alters institutional flows and triggers these highly predictable traps.
Let's quickly recap our prep sheet before the opening bell rings. We started by looking at the macro tug-of-war. The S&P and Nasdaq are hovering in neutral pre-market territory, caught between the relief of a 3.5% year-over-year CPI print, lowering the discount rate, and the very real stagflation risk of a naval blockade in the Strait of Hormuz, pushing Brent crude to $85. And we are waiting on that 8:30 a.m. PPI print to break the tie.
Right. And from there, we looked under the hood at the aggressive pre-market gappers. We saw AI hardware completely cannibalize legacy software budgets. The structural traffic jam was perfectly illustrated by ASML's 9.33 billion Q2 beat versus IBM's historic 25.2% crash. The liquidity is flowing exclusively to the hardware bottleneck.
And we wrapped up by detailing the technical levels. We highlighted the 7,600 and 29,989 VWAP pivot levels you need to watch to avoid the morning gap-and-go liquidity trap. But more importantly, we broke down how cash-rich megacaps are weaponizing high interest rates through reverse duration against retail bears.
It changes the whole game.
It really does. Knowing these structural realities prevents you from panic selling when the crowd does. It allows you to step back and see the entire chessboard clearly. As you finalize your strategies for the trading day, I want to leave you with a final thought to mull over. We saw the data today. Major corporations are literally zeroing out their software and consulting budgets right now just to hoard ASML-powered AI hardware. But what happens to their day-to-day operations over the next 2 years while they wait for that newly built AI infrastructure to actually pay off? Are we about to see a hidden productivity gap in the legacy economy simply because nobody wanted to pay for standard IT maintenance? Keep your eyes on the tape.